The challenge that we have in property investing in Australia is that the market spookers talk about just the positives or the benefits of investing, talk about cash flow versus positive gearing, negative gearing versus capital growth. But to me, they are just the components of the return. And in any investment, risk and return goes hand in hand, because the whole investment industry is based on the expected returns or the rewards for the risk you are taking. So if we're expecting any returns, underlying, we are actually taking some risk behind it.
Welcome to the Get Invested podcast, where we share great conversations with experts from all walks of life to uncover their secret know-how and where they invest their time, their skills and their money, and the benefits that this has created. You see, the truth is that everyone invests. Every minute of every day, we're investing our time, our skills, our energy and our money in something. Some of us are investing consciously, some unconsciously, sometimes for good, sometimes for bad, and sometimes for no impact. Get Invested will help you to start living by design, not by default. I'm going to help you to make it happen, not let it happen. You'll hear the top tips on how you can live with conscious intent so that you can live more, work less, and leave a living legacy by investing now. Listen to the show to discover the top tips on how to get started, make the most of your investment journey, and ultimately to be living your dream, not someone else's. More episodes can be found on iTunes or at bushymartin.com.au/get invested. Thanks for listening, and now let's get invested.
Hi, freedom fighters. When you invest in something, how much do you consider the risks? Because it's likely that you fall into one of two camps when it comes to risk. If you're in the first camp, you allow any and all perceived risks to prevent you from doing anything. There's always some perceived risk, or some might say excuse, why now is never the right time to invest in anything. And if you adopt this approach, then your attitude is your biggest risk, because nothing and doing nothing and avoiding investing is a risk that's likely to see you live out your life in penny-pinching poverty. On the flip side, there are also those that have dollar signs in their eyes and only focus on the rewards without considering the risks. And as I mentioned recently in my introduction to Steve Moriarty's episode, most experienced investors will tell you it's the reward side of investing that gets most of the attention. Even in a low interest rate era, everyone wants to talk about where you can seemingly get high reward investments. Put simply, you'll fail more often investing as a result of focusing too much on the rewards, that are only potential rewards by the way, if the risks are routinely ignored. So, at the time of this recording, when asset classes of all descriptions are enjoying boom conditions and frenzied FOMO or fear of missing out appears to be driving investment, where the focus is on never-ending rewards, I thought it timely to revisit the balance between reward and risk, particularly in the property arena. So what's the traditional widely held view of risk? Well, most popular literature appears to define risk as volatility. But the truth is, volatility is not the same thing as risk. For example, we've never heard anyone complain about volatility when the market's going up. In fact, volatility can be your friend if it presents you with investment opportunities to buy low and sell high. Opposing this traditional view of risk are successful investors like Warren Buffett, who believe, like I do, that risk is really about permanent loss of capital. In this context, property values or share prices may fluctuate for many reasons, which often have absolutely nothing at all to do with risk. So on this basis, the concept of risk relates to a permanent loss of your capital. It's why Warren Buffett's first rule of investing is don't lose money. And the second rule is remember rule number 1. Investing is about outlaying money today with a plan to get more back in the future, however short or distant that future may be. When we speak of risk, we're really talking about possible future outcomes. So risk, in order to be useful in investing, or in fact most situations, must firstly have context to it. In other words, it's a subjective proposition rather than an objective numbers-based one. Most investments are not a 50-50 proposition. For example, successful betting in horse racing, casino games or poker is about finding asymmetrical bets. Asymmetrical means that there's a difference between the payoff probabilities and the risk. A hand of 4 aces in poker is likely to see you bet heavily, whereas if you only have a pair of 3s, you're likely to fold and wait. Now, this requires us to look and wait patiently for situations or investment opportunities that are asymmetrical. That is, where there's plenty of upside if you're right, but only a little downside if you're wrong. As I point out in my book, The Freedom Formula, everything is risky. And remember that your biggest risk of losing money is doing nothing differently. But with the right knowledge, the right mindset and discipline, risk from investing can be minimised. Again, as Warren Buffett once famously said, I put a heavy weight on certainty. If you do that, the whole idea of a risk factor doesn't make sense to me. Risk comes from not knowing what you're doing. So, find someone who's already invested successfully and talk to them about how they did it, and just follow their example. You don't need to reinvent the wheel, and copying is the best form of flattery. Everyone is scared of losing their hard-earned on something that they don't fully understand or can't control. You won't be able to completely eliminate the risk of an investment, but having a good understanding and education about what you're doing will minimise it. And if you're not an expert and don't have the time to become one, you need to surround yourself with an independent professional team of experts that you like and trust and who can guide you onto the safest path to success. And this is where today's guest, Rasti Vaibhav, comes in with part 2 of our great conversation. As you heard in part 1 last week, Rasti is an architect and ex-fund manager who rose to the heights of corporate investment, where he directly managed over $2 billion in funds. He's now one of Australia's go-to property portfolio strategists, and he's revolutionising the way aspiring Australians build multi-million-dollar real estate portfolios. As a self-made, robust portfolio owner himself, Rasti uses his unique property wealth blueprint, which combines strategic diversification and sharp negotiation skills to identify ideal opportunities tailored to your circumstances. With a keen interest in wealth building and formal qualifications across a wide range of domains, such as architecture, IT and wealth management, Rasti has made property investing the Australian vehicle of choice for financial independence and lifestyle enjoyment. As a result, he built his own positively geared multi-million-dollar portfolio in less than 7 years, allowing him to quit the 9-to-5 job to pursue his passion for helping others. As an advisor, Rasti enjoys guiding you and others to replicate his success and inspires you to follow your passions. Like me, his mission is to educate and empower you and others across the country and enable you to become a successful property investor. To assist you with this, Rasti is a licensed independent buyer's agent. He's the founder and managing director of Sydney-based buyer's agency Get Rare Properties, which deals in properties right across the country. So, as an equities analyst and later as a portfolio manager, Rasti has seen firsthand that risk and return are two sides of the same coin. So, when he assesses an investment opportunity, he tends to look at risk-adjusted returns. Essentially, this is what every investor should aim for: higher returns and lower downside risks. And property fits this bill perfectly in Australia if managed properly. This is why Rasti has used his background and experience to develop a strategic approach to property investing. Like a financial plan, a property investing strategy needs to be personalised, and it should consider a holistic account of your circumstances and your goals. Rusty loves helping people grow their wealth and believes that every household can improve its financial position through better money management, better planning, and meticulous investment execution. Many of his clients have achieved their financial independence by investing in property, leveraging his specialist knowledge and his expertise to make wise, informed decisions. And also, like yours truly, Rusty's on a mission to help as many Australians as possible, people like you, your family and friends, to escape the 9-to-5 grind and gain time to spend with your loved ones. And his recently published book, The Property Wealth Blueprint, is a big part of this vision. So today, I thought I'd further whet your appetite for grabbing a copy of his book by focusing on his entire chapter on risk, which gives you a pretty good indication of how seriously Rusty considers risk as an essential part of your investment approach. Because your number one priority as an investor is to focus on risk. And by that, I mean don't lose money. Before you buy an investment, think about risk. Consider how the investment could lose money and what you need to do to prevent this. Unfortunately, especially in boom times like we're currently experiencing, most investors only focus on the reward without considering the level of risk and their probability. So to get you thinking seriously about the various types of risk and what you can do to minimise their impact, let's extract Rusty's thoughts on risk from his book, The Property Wealth Blueprint. And he kicks it off with a great quote from Winston Churchill. Let our advanced worrying become advanced thinking and planning. Rusty emphasises the need to embrace the upside risks and manage the downside risks. As Rusty reinforces, if done strategically, property investing can offer you the life you want. All smart and successful real estate investors conduct a thorough real estate market analysis and tread cautiously. Risk and return go hand in hand, and investing in any asset class is all about balancing the two. Property investing is very rewarding and is risky at the same time, more so given the high leverage involved in this asset class. Once you effectively manage the downside risks, you can then expect reasonable returns from your investments. Mitigating risk refers to a strategy geared to reduce your risk exposure. So, in this chapter of Rusty's book, I'll unpack 10 substantial risks that you and every property investor may potentially face. In addition, we'll analyse the ways to thwart, mitigate or embrace these risks. So risk number 1 is market risk, which is actually also an opportunity. Market risk refers to the likelihood that an investment's price may fluctuate. Price movement is constant and is governed by the factors that impact the overall performance of financial markets. While this is one of the biggest threats, it's also a significant opportunity to build wealth. The risk associated with a market, also known as systemic risk, arises from the inherent uncertainty of investing. Price volatility, sometimes, is a consequence of various unanticipated effects from multiple underlying factors that influence the entire financial market. However, price fluctuations can be favourable too. That is, the value of a property might increase instead of a decline. After all, that's the expectation you're investing for. The property market is cyclical and, at times, external factors may cause market-wide slowdowns or speed-ups. So, how to handle this risk? Well, the good news is the Australian property market is not homogeneous. This means there are markets within markets within markets, and they all exhibit different property cycles. Some property cycles are asynchronous or uncorrelated. That is, when a specific market surges, the other one may collapse. Keeping track of the market cycle will help you to avoid this risk. By gaining property exposure in the markets that are unsynchronized or they're experiencing lesser correlated cycles, you may be able to examine the subdued impact on the overall portfolio performance. So, to mitigate this risk, start by diversifying your property portfolio. Consider the following aspects to reduce the impact of market crashes or downturns. Firstly, invest across different locations by becoming a borderless investor as opposed to a backyard investor. Buy different property types. Focus on different demographics. Include budget variance. Buy the property below the market price if possible, because this gives you a safety net if the market slumps due to external factors. Now, in this respect, a skilled, experienced and independent buyer's agent can help you to embrace this potential risk. Risk number 2 is property risk. Now, property risk may include either natural, a la forces of nature, or unnatural threats, like malicious or unintended damage caused by a tenant. Sometimes specific risks are inevitable, but their impact can be reduced by, firstly, buying stable and sound properties. You should always conduct a proper building and pest inspection before purchasing a property, which will expose any issues the property might have. The reports will also help identify if further investigation is required. Secondly, maintaining the property. Conduct regular inspections and fix minor issues before they turn into big hassles. By maintaining the integrity of the structure, you'll ensure it's stable and robust. Thirdly, buying adequate building insurance. Ideally, you should have your insurance in place as soon as the contract's signed to ensure that you're adequately covered. You can always buy insurance directly. However, a qualified insurance broker will help you review and select the best insurance cover to suit your requirements. Fourthly, and very importantly, buying appropriate and specialist landlord insurance. Picking the right tenants through the right property manager may not be enough. You need to make sure that you are adequately covered for any malicious activity by the wrong tenant. The rental default clause should also insure against rent loss. This means securing a specialist landlord insurance policy from an expert provider rather than the off-the-shelf landlord insurance policies offered by the larger general insurance companies, where their landlord insurance is actually not worth the paper that it's written on. Risk number 3 is overcapitalisation. Property investment is one of the few asset classes where you can physically enhance its value by undertaking repairs or renovations. Improving a property is perfectly natural for an investor, but there's a risk that the investor may overcapitalise, that is, spend more money than required or justified. In these cases, the investor may not be able to recoup the money they spent when it's time to sell. To avoid overcapitalisation, consider the following tips. Set your goals firmly and stick to your budget. Research and understand the needs of the local demographics. Commit to doing the bare minimum. Focus on the must-haves and not on the nice-to-haves. It's mindful to consult your property strategist and property manager who can help identify the scope of your work. They understand the local market and can recommend renovations that will add positive value to your property without overcapitalising. So here's a quick case study on the risk of going over budget. Estelle decided to renovate before she sold her property in Epping in New South Wales. She started by upgrading the kitchen. Now, not content with an appliances upgrade, she also installed granite bench tops. She got really emotionally engaged and fell in love with the project and decided to upgrade the bathroom as well. She couldn't resist buying exclusive tapware and selecting elegant tiles. Now, as a result of this, she ended up spending 5 months and almost $90,000 on the project, which was much more than her initial estimate. Later, she was absolutely devastated when the sales appraisal came back with a value increase of only $60,000. Remember, it's not what you spend, but what someone thinks it's worth that counts in property. Next, risk number 4, which is vacancies. Buying a rental property doesn't mean you'll always be able to rent it out and collect rent consistently. There'll be periods when the property is vacant. Vacancies are a naturally occurring event in the property management life cycle. However, the vacancy risk is more about extended vacancies, where the property is empty for prolonged periods. This situation can be challenging if you rely solely on the rental income to cover your mortgage repayments and other holding costs. So what can you do to avoid this situation? Well, firstly, invest in a growing area that offers various attractive lifestyle amenities such as schools, hospitals, malls and parks where tenants want to live. Look for a property located near the main road which has easy access to public transportation, yet offers a quiet and relaxing atmosphere, as tenants usually prefer these types of locations. Secure a sufficient financial buffer to cover the mortgage and other holding costs if you fail to find a suitable tenant instantly. This is where we suggest you establish a war chest equity loan facility that provides a readily accessible and cheap rainy day buffer to cover any unexpected costs and expenses. You also need to treat property investing as a business and your tenants as stakeholders. Happy tenants are likely to stay longer, which reduces the chance of having a vacancy. You also need to respond to tenants' reasonable requests quickly, especially if these are about improvements to the property. Also, be flexible with your rent expectations as markets change over time. Consider reducing your asking rent by 5 to 10% if the vacancy persists. This will enhance the appeal of the offering and attract more lease applications. To further reduce the vacancy risk, buy the right property in the right location, which has a sustainable demand for rentals. Risk number 5 is bad tenants. You can encounter many issues with bad tenants, including property damage, non-payment of rent, and complaints from either the neighbours or the authorities. Getting stuck with a bad tenant can be even worse than the risk of not having a tenant at all. Additionally, there's a risk of exposure to higher costs and uncertainty associated with bad tenants. To minimise the risk and impact of bad tenants, consider the following pro tips. Select an experienced and proactive property manager who understands the local market and has stringent tenant selection standards. Insist on regular and comprehensive inspections during the tenancy to ensure that the property is well kept. Have competitive rental rates, but avoid having meagre rental rates, which may attract unfavourable tenants. And always have adequate landlord insurance. Risk number 6 is interest rate risk. An increase in interest rates will influence variable rate mortgages adversely, as monthly repayments will increase accordingly, thus straining your cash flow. However, the interest rate risk can be managed by opting for fixed rate mortgages and prudent cash flow management. Just be aware that fixed rates have some flow-on impacts, like no offset capability and potential early break costs. So talk to an investment-savvy mortgage broker like our team at Know How before doing this. Another way to reduce the impact is to shop around and negotiate for the best interest rate. You can even take advantage of the promotional rates offered by different lenders. However, beware that changing the lender too often or having multiple credit applications may seriously impact your credit ratings. So your first option should be to renegotiate with your existing loan provider and test if they can offer you an additional discount by quoting a competitor's offer. Again, regular consultation with your investment-savvy mortgage broker in your A team is strongly recommended here. Risk number 7 is cash flow. Cash flow is the net income that the property investor earns after paying off an investment property's expenses, taxes, and mortgage repayments. Negative cash flow is experienced when the costs exceed the rent collected. In such situations, you need to use other income sources to bail out the property. Therefore, cash flow risk has the possibility of generating a negative cash flow of a more significant magnitude than expected. To mitigate the cash flow risk, take the following actions. Firstly, forecast your income and expenses and allow for contingencies. Secondly, build a substantial property portfolio with sufficient cash flow to support your requirements. Consult a property strategist to help you plot your long-term strategy and build your property portfolio according to your circumstances and your risk appetite. Risk number 8 is lack of liquidity. A significant risk specific to real estate investing is that properties are illiquid. That is, they can't be easily converted into cash. This risk manifests when an investor is forced to sell a property at an undesirable price due to their financial or personal circumstances. There's no easy solution for managing this risk, so you should embrace it by maintaining liquidity in your portfolio. However, it would be better to avoid it altogether by building a buffer of liquid investments or cash, or by accessing available equity via an investment equity loan war chest that costs you nothing if you don't need it, but provides a rainy day reserve to cover any liquidity issues in a way that avoids the financial stress of having to dip into salary or savings. When contemplating your acquisition, consider your need for liquidity and invest wisely. Risk number 9 is personal risk. Investment portfolios may be negatively impacted by several unforeseen factors, including loss of income due to injury, divorce, or job loss. These are called personal risks. To mitigate this risk, you should constantly review your long-term strategy and invest in building a positive cash flow property portfolio. In other words, you should own a neutral to positively geared portfolio, ensuring that your investment portfolio doesn't depend on your contributions. Though the individual properties can chase growth or cash flow, ensure that your overall investment portfolio doesn't require too much of your cash to operate. Another effective way to mitigate the risk is to insure yourself. All property investors should have life insurance and income protection. One of the obligations of investors is their ability to service their loans while growing their property portfolio. Similarly, for unforeseen circumstances such as death or injury, you need to ensure that your family will be able to hold the investment properties. Therefore, it's important to consult a qualified insurance broker and an accountant to receive advice on the type and level of covers required. The final risk, number 10, is foreclosure risk. This risk manifests when an investor can't pay their mortgage repayments on time for a prolonged period. They default on their loan obligations and the lender forecloses. You can manage the foreclosure risk by ensuring all your repayments are made on time. You should also have an emergency fund to cover a few months' worth of repayments. And finally, parking cash in an offset account will reduce the interest you're charged and provide you with liquidity and flexibility at the same time. So in summary, to manage the risks I've mentioned, intelligent and successful property investors conduct a thorough audit of their portfolio regularly. The review includes analysing property cycles, cash flow, vacancy, property attributes, growth potential, demography, supply and demand, expected expenses, and diversification. Of course, this is a demanding process. Expertise in this field is gained from years spent in real estate investing and learning from past mistakes. Buying the right property in the right location for the right price and aligning with your long-term strategy are the key factors in managing risk effectively. This approach will help you get rich sooner and retire earlier. And as with any investment vehicle, the expected rewards are directly proportional to the amount of risk you take. Therefore, when you understand and mitigate these risks, there's a greater likelihood of enjoying the rewards. So in summary, here's the key lessons. Number 1, every successful property investment journey starts with understanding, managing, and embracing risks. Secondly, to manage risks, conduct a thorough analysis of every aspect of your investment. Thirdly, once you effectively manage the downside risks, you can expect reasonable returns from your investments. And fourthly, buying the right property in the right location for the right price are the key factors that will reduce the downside risks effectively. Now, the only risk that hasn't been covered here is your biggest risk, and that is you and your emotions, as what you believe about money and markets will be critical to your success. For more on managing yourself and your own inherent personality risk profile, have another listen to the Get Invested episodes with Steve Moriarty. Now, this is just a taste of the investment gold that's in Rusty's Property Wealth Blueprint, as his book gives you a much more detailed breakdown of what to do and how to do it, along with a raft of insider secrets to help you dynamically grow your wealth so you can live the life you desire. To grab your copy, just jump on getrare.com.au/the Property Wealth Blueprint, or click on the link in the show notes. And Rasti expands on this and many other areas that he covers in his book in the concluding section of our two-part special conversation today. And as a special bonus, if you'd like to win a copy of Rusti's book, just email me at bushy@knowhowproperty.com.au with what you consider to be your biggest risk as an investor. And then Rasti and I will send the best entry a free hard copy of the Property Wealth Blueprint. And if you warm to Rasti and his message as much as I have, then reach out to him and his Get Rare team by joining him on his free live online workshop at getrare.com.au/workshop, where he breaks down his Get Rare model, which gives you a tested strategy to help you develop a robust property portfolio that has the potential to allow you to retire or rewire early. And if you want to start or continue investing in your knowledge, join me and many other like-minded investors in our Get Invested community right now. I send you a free and exclusive monthly email full of practical self-help and wealth wisdom that our current Freedom Fighter subscribers can't wait to get each and every month. It's full of investment and lifestyle tips, my personal book recommendations, apps I use to enhance life, and much more. Just visit bushymartin.com.au and sign up at the bottom of the page, because this is just the beginning. In the meantime, enjoy part 2 of my deeply engaging and heartwarming chat with Rasti Vaibhav. I'd love for you to paint us a picture of your ideal dream lifestyle. What are you doing, with who, when? I'm putting Rapali and yourself in the picture here. What does it look like?
Yeah, it's a very broad question, Bushy. So I have to think through. So to us, the ideal lifestyle is more around like sharing love, and one has to be loving oneself first. So that's where we start as a family. Then what we can do, and what I realize is there's a power of giving in education, because that can multiply very easily. And towards that effect, we conduct workshops on education of investing in properties, because there's so much noise in the market, so many educators of different things. So we have a way to think about that. It should be personalized thing that what one should be doing. So there's a focus on education for rather strategic planning for the property investing. Lifestyle, back to the question, is more around thinking on a daily basis what our long-term goals are, how much closer are we getting to it, enjoying the journey, helping and contributing to other people's other lives around us, and how we can impact them in a positive way.
Love it. Well, I know I'd sort of mentioned this off air, but if you're up for it, I would love to actually break down what I call your freedom numbers, because it's something that everyone that I work with who comes to me and says, Bushy, I want to invest in property. I said, okay, well, let's park that over there for now until you get really clear on exactly how you want to live and how much that lifestyle costs. It's impossible to really develop an appropriate strategy that also in alignment with what your capacity and capability and your risk appetite is. So just to whet the listeners' appetite to the importance of the freedom numbers, are you open to very quickly putting some shape around that?
Sure.
So the first thing I always ask is, given that lifestyle you've talked about, your dream lifestyle income, to fund that lifestyle every year, what sort of money are we talking?
Luckily, Rupali and I are not really very high maintenance. So anything around 100K, 120K is good enough on an annual basis.
Beautiful. So in really simple terms, and using a 5% net return, then you need income-producing assets, debt-free, of about 2.4 mil on that basis. So that becomes your nest egg number that flows from it. The next thing that weaves into that is the break-free timeline. So how many years before you are going to be in a position to have that asset base. You probably already got it, actually. From what you've told me already, that you sound like you're there in spades. But what's the break-free timeline look like for you?
Sure. Bushi, would it be okay if I share my goals? Because that can potentially answer the question. Okay,
yes,
if I can.
Let's do that.
Sure. So I actually worked on that 100K number when the day I actually got my first paycheck from Westpac to work it out what I really want. Because to me, I always start with the end in mind.
Yep.
And so what we did was like 100K is the passive income we want. You just now mentioned about 5%. I actually worked out on 4% net yield.
Yep.
So that actually related or equated to $2.5 million without taking into account the inflations.
Yep.
Sort of things. And then we also accounted for principal property of residence as well. So,
yes. Yep.
So that we can say it's a debt-free home that we're living in, and we get a passive income of about 100K.
Yep.
So that putting a value of about $1.5 million at that point of time, we realized that all we need is a net wealth of $4 million.
Yep.
That can actually set up for life, for retirement. And as we know, we are talking about properties here that would actually cover up for our legacy that we will love to leave behind for our kids. So income is one part, but then also we don't want to end up with so much of big asset at the end of our lives. So we can start eating the value of those properties or that net wealth as well. So we realized that 4 million is all we are looking for. Take into account inflation, so 5 million. Actually, we thought that to be on the safer side. 5 million is what we are looking for. What I did in my strategy for myself was that how can we go about achieving that goal, and using property as a mechanism. What I aimed for at that one point of time is that how can I build my portfolio of $5 million, and then letting it, like, of course it's a leveraged portfolio that we are building, but letting it sit for a full cycle, let it double in value.
Yep.
Whether it takes 7 years, 10 years, 12 years, it really comes down to the research, the selection of the stock. And in that, after that property cycle, the value of the property might double by definition, but then my debt level would still remain the same if I'm not really paying anything extra.
Yep.
And then I can choose to sell half of my portfolio to pay off the debt.
Yep.
Effectively leaving me my net asset base that I really want it to have in my pocket.
Love it.
So this is the story, or this is the kind of planning that I did in 2010, coming from strategy classrooms, from my MBA classes, and talking about the financial wealth. And that's where we started building our portfolio, because my aim was to build a portfolio of up to $5 million.
Yep.
And and I actually, of course, that was just our aim. We got into so much of trouble with regards to our borrowing capacity or the deposit.
Yeah.
And of course, in the journey, of course, I educated myself, but of course, there were some mistakes that we made. We learned from it. We were able to do that by grace of God. Like, we were able to build that portfolio in 7 years' time.
Brilliant. That is incredible. Yep.
And that was the kind of confidence that I got from my own journey. Of course, when I look back, there were quite a few mistakes. Probably, if what I know now, I've done in less than 5 years, but I took 7 years. But there was a very valuable lesson that I've learned. So it was all worth it.
And let's share that. What are the lessons that you've learned along that journey? It's a good time to share that.
Sure. So the thing is that it's all about, like, property investing is a long-term investment, and it should be seen in the light of long-term investing only.
Yeah.
Of course, it's a bonus if there's a short-term benefit as well, because with the limited resources that we had, limited borrowing capacity we had, limited savings we had, we have to rely on the short-term growth of that portfolio as well, so that we can tap into the equity.
Yeah.
But that should never become our primary goal to make a quick buck out of the property investments. It should always be long-term with a secondary benefit of a quick benefit as well. Yeah. So never swapping the two. Like, primary goal is always long-term investment. Secondary is short to mid-term quick gains as well.
Yeah.
So as a researcher, this is what we do. We find properties which should be appropriate for the long-term investing, and trying to tap into the equity or the growth on the property immediately so that we can do it again.
Yeah.
So the challenge is that talking about long-term investing and getting the merits of quick equity from the property, it is just so much of noise in the market. Everyone is talking about property investing. Everyone is talking, like whomsoever you talk to, there are different opinions, whether qualified or not qualified. You talk to someone who's trying to sell you something, they have their own, I guess, matrix to make you feel that this is the best thing you should be doing. So it's very challenging. So I took about 14 months just to understand how market works before I actually put my first dollar into investment. And the thing is that when I came to my third investment, I was like, my first is working, second is working. How can third can go wrong? And that was the biggest lesson I learned, that I shouldn't have done the third investment the way I did it. Because, sometimes like there are lessons to be learned. And as I was saying before, if you can learn from those mistakes, they were good mistakes to have to be made or committed at that point of time.
Totally. Well, this is probably a good time to ask this question. Looking at your journey so far in the property sphere particularly, what's been your best and worst investment to date, and what are the learnings from those that you've taken away?
Sure. So before we get into it, like the best part of building the portfolio with the limited resources is to always think of a balance of the cash flow as well as capital growth, because that becomes kind of very conflicting at some stage.
Yeah.
So, and also being aware of the risk. Now, when it comes to my best investment, when I was going to the bank for my fourth investment, I was told that I can't borrow anymore after this property. Yeah. So I was like, oh dear, my aim is to build a portfolio of $5 million. And I'm actually told otherwise, like at my fourth property itself, which is like less than 1.5 million or $2 million then, how can I go about it? So it was more about how can I actively add value to the property. And what we actually did was basically found a property, a deceased state property, in a regional New South Wales area, and we bought it under the market price. We did a bit of renovation to the property, like cosmetic renovation. I did a granny flat, and that property has gone, has in the last 5 years, it has gone up by 80% or so. So it's not so much about the success as a percentage return, but what important it has actually given us is the capacity to go to the bank after 6 months straight after to borrow for my fifth and the sixth property. So to me, that property, because of being the building block to help me build my portfolio, was one of the best investments that I've actually made.
Yeah, love it. Now that and you make a very good point, and I think what I'm seeing is a major challenge at the moment, Rusty, and I'd like your comments on this, is that since October last year, as I mentioned in the opening, the property market pretty much across the country, which is a very, very rare thing, because as you and I know, right down to precinct levels, the growth cycles are all independent of each other, and they very, very seldomly sync. They are in sync at the moment, which, as I say, I haven't seen anything like this since the late 80s in terms of the level of growth. And I guess I'm talking about how I'm a bit of revealing how old and how crusty I am around that. But I think the biggest challenge that a lot of recent investors have is that they are going to lull themselves into this false sense of confidence where they're seeing this incredible growth right now. And as you and I know, I've done a lot of research on this, Rusty, and if I look over the last 30 years, if we look at an average time to go through a full property cycle, it's actually 15 years. Now, you might get lucky and get it in 8 or 9, but I think it's more luck. And I'm one of those people who goes in and plans for the worst and then expects the best. So my fear for a lot of investors is, yes, they're going to get a nice little equity uplift in the short to medium term for those that are getting in now, but they're probably not ready for the desert because, as we all know, the cycle is generally a spike of growth over 3 to 4 years, and then it might even come back slightly, and then it'll plateau between 5 to 8, and then it'll spike again. The biggest challenge and the reason that I think most investors don't get past their first property, or they sell their property, 50% are selling it within 5 years, is because they're not prepared and they haven't structured it well to cash flow through the times when we're not seeing a great deal of growth. What's your thoughts around all of that?
No, great summary over there, Bashi. So I can't agree more that what we are seeing in the last few years, not just last year, is the young generation who has been investing is only mindful of what, as an example, like what the metros like Sydney and Melbourne has done in terms of the performance since last maybe 7-8 years, and the sense of diversification or risk awareness is slightly underrated at this point of time, and lots of people actually made quick money over the last few years when it comes to buying, home and land packages, and the property market has gone up, and they realize that just by booking or making a booking for the land release, they have actually made hundreds of $1,000s. The question is that how sustainable it is, because they have not really seen any drop in the market, or they have not really seen the interest rate hikes or the hiked interest rate, what we have seen in the past, as you mentioned, late 80s, the rates are nothing compared to what we have today.
Yeah.
And to me, it's all about clarity of the long-term goals.
Yeah.
And also appreciating the risks around it. Like, what if this happens? What if this doesn't really work out to the expectations? Because you mentioned very succinctly that there's a difference between 95% and 5% of successful investors, and statistics says it all, like 72% property investors have only one property in Australia, and then other 18% have 2 investment properties. But now what it tells us is like cumulatively 90% of property investors can't go beyond 1 or 2 properties.
Yeah.
Now the question is, and we also know that to have a meaningful designed lifestyle by property investing, we need a portfolio of 5+ properties.
Yeah.
Now the question is, if for among those 90% investors, if it was working, then why not they are not doing it again? Gives me a signal that it was not really working for them at the first place, even though they have taken advantage of this market. But it's more about the lack of strategy or confidence or the risk buffers that doesn't allow them to go forward. And sometimes it's more about the clarity that one has to have to move forward, because as you mentioned earlier, like sometimes we don't know what we don't know. And I guess coming back to your point that 1 year, it has been great. Yes, you're right. 15 years is on average is what we also see, but that's where the research comes into play, because there are areas which it's more of a diversification of the portfolio. We are not really going for a quick money here and quick money there. It's more about steadiness, because at the end of the day, if we have a $5 million portfolio as an example, let's not kid ourselves, there's a $4 million borrowing as well. So we have to be comfortable around that leverage or about that debt level. And that can only come when there's a steadiness in the growth profile, being aware of those risks that we are taking deliberately, and covering or mitigating those risks that we can't avoid altogether.
Totally agree. And that risk piece, and I coming from your equities analyst role, looking at the risk-reward ratio, because they are really important. I see way too few investors put any energy into the risk side. The big focus on the reward side, very little focus on the risk side. But what's your read of that?
Exactly right. So when I started writing my book, like I envisioned writing a chapter on risks in property investing, and I couldn't really hold myself back. I actually launched a chapter as an ebook early on the risks in investing, so that we can be a bit more mindful of those risks. And The challenge that we have in property investing in Australia is that the market spookers talk about just the positives or the benefits of investing, talk about cash flow versus positive gearing, negative gearing versus capital growth. But to me, they are just the components of the return. And in any investment, risk and return goes hand in hand, because the whole investment industry is based on the expected returns or the rewards for the risk you are taking. So if we are expecting any returns, underlying, we are actually taking some risk behind it. And now risk is a dirty word because lots of people think risk is something that we should avoid. Of course, we should avoid, but only if they are bad risk or like a downside risks. The whole reason we are investing is for the upside risk, as in the growth, expected growth. Because there are quite a few ways that we define risk in investment industry. And the way I define risk is, like lots of people define risk is the volatility, as in like the unknown part of it where it would end up or down. So that's where I was referring to the upside risk, as in like the value coming up in value.
Yep.
But then to me, when it comes to the wealth management, it's about preservation of your own capital. Like when you are putting money, are you preserving that capital or are you risking it to lose it altogether? So in what we do or how I have done myself for my own portfolio, for my family, and now for the people that I work with, we are mindful of preserving the capital, making sure that we don't want to risk it unless the person has the appetite for it or the capacity to take risk. Because more risk we can take, it also exposes us for the upside risks. So it is a meaningful discussion that we have around those, and one has to be comfortable and being aware of those risks that we are taking together.
Love it, because you're absolutely right. There'll be the big focus on the upside, so they'll all talk about the capital growth they're going to get, etc. But if you're looking at getting a 5 to 7% return, but you've got a 50% risk associated with the capital that you're exposing to do that, then you've really got to question the merits of doing so. And that's the question that I just don't see, I see very few people asking. So love the fact that your strategy encompasses that. That's a great segue, I think, into, because you mentioned writing the book. Let's talk about that now, because the Property Wealth Blueprint, I've had the privilege of reading it thanks to you. Great read. Let's break that down a little bit, because I think there's some absolute gold in that is worth sharing, and would really encourage anyone listening to grab themselves a copy. Why did you write it? What are the key messages, and who's best suited to take advantage of it?
First of all, thank you, Bushy, for reading through the book, and appreciate your appreciation of the book. The reason I actually wrote the book is that it's more of a learnings that I've actually had from my own experience of investing, as well as the learnings from other investors that I've actually come across, had the privilege of working with them or learning from them. And I thought, like, a small read, like in a couple of hours, like if I can share my knowledge of investing or things to avoid, having a clarity of the goals. I thought of packing it up in a book, because this is what I actually run in my workshops, the live workshop that I run. But then I realized that it's sometimes it's not really very, I guess, convenient for everyone to come along in the workshops, and book is the best way for me to share my knowledge for the benefit of a potential investor. So that was the idea of writing a book. It covers quite a few things, though it's a small read. The key thing, if I have to share, is that one should have 100% clarity of the end goal. Like I'm a big fan of the book Start With Why by Simon Sinek.
Same here. Yep.
Awesome. Great minds think alike. And he talks about, like it's the why, it's the passion that will fuel your power, your engine to get to your goals. So the stronger of a why, the more motivated we would be to achieve that. And that's the same thing, like property investing is just like any journey is full of ups and downs. And if we have the clarity of the end goal, we know that this is the part of the journey, and we have to take the downturns with a open mind, accept that as a part of the journey, and being mindful of them. So clarity, just like what we were talking about, like when you were asking me about my freedom numbers, this is what actually I'm talking about in the book as well. Like, work out your freedom numbers. What will it means to you? What is your motivation? What's your passion to get there? And the second part of it is like, yes, there's so much out there to learn. But as I did myself, like I didn't know much about stock investing. I got the right team, right money manager to manage the money for me. And that's the other thing that what I actually mentioned in the book is that you have to treat property investing as a business. Now, the first part is, for any successful business, you have to have a very full, proven, tested business plan. Because, Bashi, as we know, without plans, we fail. And like if we fail to plan, we are planning to fail. And so that's one part. Like, having that strategy, having that blueprint is super critical with a view of the end goal. And then second part is like having that, like any business is incomplete or incompetent if there's not much of a reliable, trusted team to contribute together to achieve the goal. So those are the two things. But of course, like, this is very a high general summary that I'm giving. Having the strategy and having the business, having the right team. Of course, I've also touched upon the risk in investing, the typical mistakes people make, and as I said, like, starting with the why is super critical. And that's where the book is starting with, like, why one should be considering properties, why one should be thinking, even before that, why one should be thinking about investing. Yeah. So I'm a big fan of thinking about constraints that we have. Like, as a child, like, we had aspirations. All of us had aspirations. But then as we grow, we have the challenges of the life, and then we forget about desires. And I'm actually challenging the reader to think about what their deep desires, or deep down desires were, and why they're not achieving it. And typically, for a young family or young adult, like, we are talking about the time as a constraint, because almost 90% of us are actually trading time for money.
Yeah.
And it's not the time that we are actually short of, it's the money that we are short of, effectively, because we are trading time for money. And what I'm actually challenging the reader is to think about what they really want and how they can win their time back while generating money on the sidelines by passive investing.
Love it. You sound like me talking. Rasti, I can't believe how similar we are in our outlooks and beliefs around that. I love some of the language that you use, the envisage it, design it, and then execute, plan it, design it, and build it. And that's our architectural flavour coming through, but it's so applicable to what you need to be doing in terms of being successful in the investment arena, that it's a great analogy. I also, and you just touched on it then, but I'd love for you to share there's a great analogy that I've picked up on the book as well, where you talk about time, money, and energy being the three key resources. And again, we're on exactly the same page, and I use the same language here. But just share with me, because it's a great little capture on the key elements of that. Can you just share your little analogy you use around time, money, and energy?
Sure, with pleasure. So what I actually noted in the book is that we are always looking for these three constraints, or these are the three constraints that we typically have. So time, energy, and money. So when we are young, we have a lot of time, a lot of energy, but probably we don't have much money. In our adulthood, we have money, we have energy, but we have no time because we are just busy scheduling things. And in our later stage of life, we have potentially we have made a lot of money by that time. We have a lot of time, but then we lack energy. And now the challenge is that for us to live our life to its limits, we really need these three elements, time, energy, and money, concurrently at the same time. As in, like, concurrently, we need to have all three elements for us to enjoy life. And that is actually leads me to the challenge that if we are so busy making a living, when are we actually living? And that leads me to the solution part, which I found myself by reading this book, Rich Dad Poor Dad by Robert Kiyosaki. And big fan of the small book, amazing read. That book actually made me wonder like why what I'm doing, because we can work like a typical family can work for money, but the moment we shift ourselves into the right hand quadrants of the cash flow quadrant, like which is like instead of being just an employee or self-employed, if we choose to leverage money as a business owner or investing as systems,
Yep.
we can make money work harder for us. And that's what the rich class is doing. Actually, they have the systems, they have the money that is actually going out and making more money for them while they are spending time on the beach or playing golf or traveling around. But we as an average person, we get stuck for making money and forgetting about that. If we have to, like, we should really think about making that money work harder as well, so that we can slowly move towards the right hand quadrants.
Love it, love it. I had my Kiyosaki moment in the late 90s, Rusty, because it was absolutely revelational. And I actually went and saw, he was actually in Adelaide at the time, and I went along and saw him. And he made the comment, the moment you make passive income a part of your life will change. And that was an absolute light bulb moment for me. And everything I've done, Sonia and I have done since that point in time, must have a passive income component to it. So our business is that way, our investments are that way, everything. We became what I affectionately refer to as we became passive aggressive about pursuing passive income from that day onwards, and it's been the best thing that's ever happened to us as a consequence. Absolutely love that. I want to switch gears now into the business. So the book is a great read. There's the habits of ineffective property investors. There's a whole bunch of stuff there that is just really sums up the key elements. And as you've well said, it all starts with the clear vision, because that becomes both a magnet and a compass. It's a magnet in terms of keeping you on course because that's where you want to be, but it's also a compass because if that's compelling enough, every decision you make day to day is about whether it's taking you closer to it or further away. So I love what you're doing in that space. I'd love to briefly talk about Get Rare Properties, because the unique investment system that you've created there. Can you just give us a little bit of shape around that? Because while a lot of Australians aren't embracing the buyer's agency industry yet, there are quite a few that are starting to pop up. So I'd love you to share just the key elements of the unique part of Get Rare Properties investment system, and then why should an investor look at engaging Get Rare to help them?
Sure. First of all, thank you so much for your kind words about the book, as well as what I'm trying to achieve here. Just quickly sharing about Get Rare Property Investment Systems that we really living and breathing on a daily basis is taking a person through a journey of where they are to where they really want to be. Now, property investing has been very successful way of building wealth, provided it is done in the right way, and it should be right for the individual or the family. Now, what actually it has given me, the kind of careers that I had in the past as an architect, as an IT data analyst, systems engineer, then as a money manager, I'm actually combining all of those elements together in this Get Rare investment systems. And that is thinking about as a wealth creation system, like where we are, where we want to be, taking into account the risk appetite, the saving power, and understanding the markets as well, because that's where the research role that I actually learned in my equities analysis role, that it's all about supply and demand, and it should be personalized for the individual's journey, basically.
Yep.
So the blueprint gives that element. So when somebody comes over to us and seek our professional help, we actually sit down with that person or the family, understanding what their long-term goals are, because true to the word that we should start with end in mind and goal in mind. We actually sit down, we paint the picture of what we really want to achieve in the long run. Like we talk about 15, 20 years down the line, what is that what we are trying to achieve? Something similar to your freedom numbers, what it's looking like, and how we can achieve with the limited constraints that we have, like limited resources and the constraints, and that includes the risk appetite as well. And the way we define risk in our financial world, it's just more about not just the willingness to take risk, but also the tolerance level of the risk that one can take. So ability as well as the willingness. So what we have done in our unique system is that we have brought that financial planning element to the property investing side of things. And because we talk about building wealth, we are really aiming for multi-property portfolio here, rather than just thinking about buying our property. So this is what we do. We understand what they are looking for. There's a lot of education as well. There are a lot of challenges thrown to us. The questions, city versus regional, unit versus house, cash flow versus capital growth, understanding the risk, overall strategy of diversification. So we take that person through the journey. And as an example, like we have been working with Linda, and until 7 months ago, she had no clue what to do. She's well read. She understands the theory of property investing. But when we sat down together with her, she was very much clear about her long-term goals, and she clearly knew that she wanted to build a portfolio. And true to our word, we have delivered to build her portfolio so far. So now it's only been 7 months. Now we are looking for the 4th property for her already. So she has achieved 3 properties, and she has a lot more confidence in her ability to build wealth in property investing, because we are talking about the economics of property investing, the indicators, the leading indicators, helping her with the research.
Love it. And I love, in reading the book where you break down the Get There model into the 4 key stages of investment, from acquisition to growth to consolidation to then finally financial freedom, which you've mentioned before, and then the systematic approach to actually selecting the right property that's going to suit that. So looking at the right strategy, the right attributes, the right location, the right property, and the right price as an overall package, rather than what most people do is they just focus on 2 of those elements, and that's property and price, without looking at the massive contribution that location makes. And in my own experience, 80% of the growth comes from location, but it's also got to have the right attributes. So that's certainly an important part, and that's where the architectural background becomes very handy. And ultimately, what I see way too many investors do is they don't have a strategy at all, yet alone the right strategy. So love the work that you're doing there, mate. It's massive contribution, and it's really good to talk to someone who shares that same passion and that same approach, which is very rare. What I'd love to do now, if I can, is bridge into what I affectionately refer to as the ambush round, or the bushfire lightning questions that I ask of every guest that comes on board. And we'd love to get you to share your words of wisdom, starting with what's your favourite quote and why? Sure.
So my favorite quote, I knew that you'll be asking me this. So my favorite quote is from Pablo Picasso. His words are, "Our goals can be reached through the vehicle of a plan, and there's no route to the success otherwise." So I repeat, goals can be reached through the vehicle of a plan, and there's no route to the success otherwise.
Love it. That's absolutely self-explanatory and a cracker, right? Given our sort of joint belief in that exercise. You've mentioned a couple of books already during our chat, in addition to yours. What would be the top book you'd recommend reading, and why?
I did already mention about Start With Why from Simon Sinek. Yeah. And the other book I would also add is Rich Dad Poor Dad from Robert Kiyosaki, if they've not read it. But my personal best would be Who Moved My Cheese? I have to think about the author now, sorry.
That's all right, yeah.
Yeah, so the book is more about 2 mice, and It's just more about being proactive because one mice is just used to finding the cheese in the corner every time in the corner of the room, and he was all right compared to the other mice who always looked around, developed his skills to find mice, even if the cheese has moved around. So of course, as they were like the second one was more adaptable, and he was able to switch gears when the cheese moved around in the room, and he was able to find it.
Love it, love it. Okay, yeah, this one's a little bit left field, but a lot of Aussies believe we pay too much tax. I think you've got to pay tax to enjoy the community benefits that we do in Australia. Someone's got to pay for it with a very small population. But that aside, what's the top legal thing that you've done to minimise the tax that you pay, Rusty?
Yeah, I'm actually a firm believer of my value system for money is abundance. So I would actually, on the contrary, would love to pay more tax because what it means is that I'm actually earning more. And but to answer your question, my best way to, first is very logical to make contribution to the super, but I actually rather have more control for my money, so I rather keep it to myself. But I actually used to donate a fair bit of money, and that actually is tax deductible. So for me to reduce taxes, the best way is to donate.
Love it. Love it. Yeah, brilliant. Now, back on the investment subject for a minute, what's both the worst and the best piece of investment advice that you've ever received to date?
The best advice has been to invest in yourself. What stays with you as knowledge will stay with you forever. Nobody can take it, and it will only grow when you share it. So investing in yourself, getting the mentor, getting the right mindset, that is probably I got it very early on, and I'm true to that word. I'm still having lots of coaches helping me with next step, what I'm trying to achieve here. Worst advice, probably early in the stage, whereby I was told that this is growing in value. Why won't you buy something which is growing in value? Only to find out in a couple of years' time, that was a lemon that I actually bought. So never listen to, I guess, short-term metrics or short-term, when the focus in the short term, it will remain just a short-term investment.
Yeah, well said. Finally then, what's a personal habit, or I call them happy habits, or a daily discipline, or a rewarding ritual that you adopt that you believe has contributed most to your investment success today?
Sure. So personally, I actually believe in gratitude, thanking each and every aspect to the life. But when it comes to investing, I think the habit that actually helped me a lot is about thinking about the future, forecasting, planning for it, and also reflecting upon the past so that we are still grounded. So forecasting and reflection, basically, I would say, are the daily habits that I actually have pursued on a regular basis.
Love it. Now, sort of bringing it to a close, if you reflect on our conversation today, Rusty, and you look back on your life journey so far, and you try to sum this up in a couple of words, where have you invested your time, energy and money to date, and how or if will this change in the future?
Sure. I think financially I'm all settled from the vision that I took about fair time ago. But for me, moving forward, it's more about my passion to help other people to live the life with a purpose, with their own passion, and helping them grow and financially will free up their own time so that they can do things they really wanted, has become my purpose or my passion, which I call it as my duty as well now. That what I've learned in the hard way will allow me to pass it on to someone who can do it, or maybe handhold them as a business, as a getting properties.
Yeah, I love it. Your dharma, as you describe it in the book, mate, which I think is a great way to call it. And I also love the way, in doing the research for the exercise today, I realised that your first name, Vaibhav, in Sanskrit actually translates into moral, ethical, abundance, or right path. And it's interesting how you've become the outward expression of all of those key terms, Rusty. So love the way you've done that. To the last question then, which gives you an opportunity to really sum up the key messages that we've spoken about today. If I gave you a microphone that spoke to every single one of the 7.7 billion odd people that are currently alive in the world, and I gave you roughly a minute to talk, what would you suggest they invest in?
Sure. First of all, thank you so much for your kind words around research of my name. Really, really appreciate it. If I have the opportunity to speak to that many people, I'm humbled, first of all. I would say that have a clarity of the goals. Because if you have clarity of your end goal in mind, that will fuel your passion to achieve it. And that clarity will by law of attraction, the universe will manifest and get those means for you to get there. So there's a lot of power in thinking positive, thinking about your long-term goals, putting in words, believing in itself as well, because having a clarity is one thing, but then one should have a belief as well. And this is exactly what I've achieved. 2010, I had no clue what I'll be doing, but I knew that after 10 years, I really want to retire on the beach, and this is what exactly I'm doing. And thanks to that power, thanks to that belief system, that actually allowed all the resources around me, the law of attraction really works. So having a clarity of the end goal. Now, the thing is that there's not much time for us to go out and figure out how things will work. If we have the belief system and the mindset to take help, the professional help, get the right team, because having a goal is just one part, then there has to be a strategy or the blueprint or the plan or the GPS for us to get there that can guide us to achieve the goals, to get to the end goal from where we are, appreciating the resources or the constraints that we might have today. And for that, we really need that strategy or the GPS. Just like the car, in the car, we know exactly, like we don't follow in the straight line of our goal. Like it just works out the most optimal way to get to the point B from point A. And that clarity with the mindset of having a plan, plus the other thing is that there's no point for us to commit mistakes, learn from our mistakes. When somebody has already made those mistakes, we can learn from them. Why reinvent the wheel? When we know there are successful people out there, successful professionals, of course, there might be an element of fees that we have to pay. But in scheme of big things, always think about that, what that goal means to you, what that vision, what is that clarity. Like, if you can really feel or see yourself in your success position, whatever it is, whether it's like running a marathon, imagine yourself crossing that finish line. How would it make you feel? That vision, that kind of a sense, we have to breathe in at every step while we are running, because in the marathon, we'll always feel the cramps in our body building up, and there will be always an urge to give in and take it easy. But that belief that we can run the whole marathon, as an analogy, and having that sense of accomplishment will keep us going. And believe me, that's such a wonderful feeling to achieve the goal. And we don't have to achieve the goal to feel that feeling. And if we have that feeling, not only the destination or the goal achievement will get us that feeling, but positively contributing to the success of the goal and the journey itself will be very fulfilling. So if I have to summarize this thing, what I'm saying here is that have the clarity of the goal, have a blueprint, have a strategy to get there, and have the team. Like, I can't run marathon on my own. Like, I have to go for someone who has run the marathons multiple times. He or she knows very well, as a coach, as a mentor, what are the do's and the don'ts. Because when we start running, we don't really just run straight away. We have to train our muscles first. And same thing goes with creation of the wealth. Having that clarity that I would have that kind of passive income with a fully paid off home gives me that vision that, okay, I should be doing something. I should be educating myself to do something today. Having that blueprint, what should I do today to get there? And then having that team who can help me, who can support me, and picking that right team is so important from that aspect. And that where is comes a mindset that we have to go and try out and ask around what's the best way to get there. Because lots of people, what I found is that they are always looking for the solution for the immediate problem rather than thinking about the bigger puzzle, bigger problem that we are trying to solve, and then trying to work it out what's the optimal way to solve the bigger problem set that we have.
Love it. Love it. Yeah, what we think about is what we bring about. I've always said that, Rusty, and it's the end point, but it's also the starting point. So you said that beautifully. For those listeners who are, motivated by what we've talked about today and can see that, Get Rare Properties can really assist them with that approach to really start building their own portfolio to achieve their own lifestyle goals long term. The book, obviously, The Property Wealth Blueprint, is a great start to really embed that. But for those that, because you mentioned the workshop, the free online workshop, for those that want to sort of start going down that journey, how can they access that?
Sure. So I do write a lot of blogs as well. So I publish all of them in my company website by name of www.getrare.com.au, and we have a link for the workshop over there. So it's getrare.com.au/workshop, and all of you are invited to come along and check the workshop out. Like I run through that Get Rare model, breaking that into the simple steps that one should be following, and the element of research, the deep dive that we should be doing to get to the right strategy, to the right property. So it's more of a case study based workshop that I run. So the next one, I do it on once in a month at least. So and with regards to the book, there's a website for the book itself, which is like thepropertywealthblueprint.com. You're more than welcome to check it out.
Love it. Love it. Been an absolute pleasure, Rusty. Great to see a brother in arms that has a very similar and quite a rare approach. I have been challenged to find people in the industry who adopt the holistic and integrated but personal and customised approach that we clearly both adopt. So this will be the beginning of the journey for you and I, and really appreciate you spending your very generous time on Get Invested today.
It has been my pleasure and an honor. Thank you so much, Bashir. Really, really appreciate it.
Terrific, Rusty. We'll be in touch. We'll talk again soon. Bye for now.
To get a summary of all this investment gold in the show notes, just email me on hello@khgroup.com.au. It's hello@khgroup.com.au. Or check us out at www.bushymartin.com.au/Get Invested. I look forward to joining you next week for another episode of the Get Invested podcast. So thanks for listening. And as always, dream as if you'll live forever and live as if you'll die